Welcome to Pips Lab. In this video, we are going to talk about technical analysis and currency pairs. This form of trading is when you analyze the market using indicators, charts patterns, candlesticks, Fibonacci, support and resistance, pivot points, Elliott waves, etc. When you use any of the above to analyze the market, it's called technical analysis. The majority of what I listed on the course outline is technical analysis. It's the most popular form of trading. This is because high volatile news is not released every day. So you can't just depend on fundamental analysis alone. Every day can't be Christmas. So as a Forex trader, you must learn how to trade the market using technical analysis. So because every day can't be Christmas, high volatile news like NFP is not going to be released every day. So you have to learn how to analyze the market and trade in the absence of any major news release. That's what makes you a complete Forex trader. Among the two major forms of analysis, no one is superior to each other, and also no one is used in isolation. So you would learn as we move on how to harmonize the two to constantly keep you on top. Now let's look at currency pairs. With Forex trading, you can grab the skill faster if you practice what you learn. We would all need to open our MT4 and MT5 apps. These apps can be downloaded on Google Play Store or Apple App Store. Let's open the app and register it. We would all start with demo accounts. So open the app. It would automatically create a demo account for you by following a simple steps. You would see where is written, start without registration. That automatically creates a demo account for you. That is what we would be using for now. For those that have logged in, you would see where currency pairs are listed, like in the image above. Even if it's in a different format, don't worry. The most important thing for now is that you are seeing the currency pairs. We will address the formats later. EUR, Euro, USD, US dollars, GBP, Great British Pounds, CHF, Swiss franc, NZD, New Zealand dollars, AUD, Australian dollars, KD, Canadian dollars, JPY, Japanese yen, CNE, Chinese yuan. These are just a sample of them. I will send a summary of all of them after the presentation. Among those pairs of currencies, the first currency within the pair is called the base currency, while the second currency within the pair is called the quote currency. An important thing to note here is that the base currency is always stronger than the quote currency, with few exceptions, and we will see why soon. Let's take Eurist as an example. Euro is stronger than the US dollars. I believe we all know that. Hence, Euro is the base while USD is the quote. Another example is USD-JPY. With this, US dollars is the base while Japanese yen is the quote, because the USD is stronger than the Japanese yen. Hope you get this now. Also, beside each of those pairs, you would see some set of numbers written by the side. Just focus on the first number after the decimal point for now. For example, in this USD above, it's showing you USD 1.1262. That number is telling you how many units of the quote currency you would need to get 1 unit of the base currency. Let's note the above statement. Let me use a local scenario to give you guys an example. If you have a currency pair between USD and Ghana cedis, i.e., USD GNS 10.55, this is first telling you that USD is stronger than CEDI, hence USD is the base, and CEDI is the quote. Then the next important thing it tells you is how many quote currencies you need to get 1 unit of the base currency. So in this case, you would need 10.55 cedis to be able to get 1 US dollar. So that is what that number by the side always tells you. How many quote currencies do you need to get 1 unit of the base currency? Let me give another example on the chart to make it clearer. Let's take a look at USD-JPY. In the image above, it's currently at 110.37. It's telling that you would need 110.37 Japanese yen to be able to obtain 1 US dollar. Now, recall what I told you guys earlier on that the base is always stronger than the quote. There are some occasions in which the stronger ones are written as the second pair. Examples include AUD. US dollars is stronger than Australian dollars. NZD/USD. US dollars is stronger than New Zealand dollars. EUR/GBP. Pounds is stronger than euro. You always know them because they start with 0 points or something written beside them. The image on the screen is an example. Now, when you see these few exceptions, don't bother about why the weaker one is written first, even though it's quite glaring that the quote is stronger. What you just have to do is to take note of them. It doesn't affect your trades in any way. It's just for the knowledge's sake, so note them down. However, apart from those few exceptions, generally in Forex, the base is always stronger than the quote. From this, the USD is stronger than the NZD, but NZD is written as the base whilst USD is the quote. We will now move to another very important part of Forex trading. This is where many people always ask questions. For your foundation to be strong in Forex, you need to grab this concept. The big question now is, when do you buy and when do you sell? Now, this is where people always get confused. You buy when you know that the market will go up, while you sell when you know that the market will go down. So as usual, I would use a local scenario to explain this topic. By the time I'm done, this seemingly complex concept would look very easy to you. Believe me, nothing is hard to understand in Forex. Just tell yourself that even if young boys who are not even half as educated as you can do this, then you too can do it. Let me use this analogy to explain what I mean. Let's get to the analogy to understand in a layman's way how Forex actually works. 6 years ago, $1 was around 4 cedis. But within the past 3 years, dollars shot up from 9.7 cedis to 14 cedis per one. So, assuming you knew the dollar would appreciate against cedis like this, and you had 1 million cedis lying fallow in the bank account, you knew from your experience as a Forex trader that uncertainty in government weakens a currency pair, and you used this 1 million to buy dollars and kept before the past 3 years, it would given you about $250,000. Now, 5 years later, the dollar just escalated to 14.5 per dollar. And you went to the bank, cashed out your $250,000, and exchanged it back to cedis. It would now yield you $2,425,000 cedis. Remember, you just stocked 1 million cedis. That means you made 1,425,000 cedis profit. Now ask yourself, did you use that 1 million cedis to do any physical business? The answer is no. You practically did nothing. What just happened right there was Forex. You leveraged the fluctuations in the price of dollars to cedis to make yourself money without doing anything. You just sat at home while the foreign exchange market did the job for you. This is basically what we do in Forex. This is not the normal market at Accra Mall where you buy and sell clothes or other stuff. Some people always ask me what buying and selling are. This is just a raw analogy because in the Forex market, it's even more interesting. You don't have to wait for 1 year or months to make money. These currencies are constantly fluctuating in minutes, what I usually refer to as volatility. So it's those opportunities caused by these fluctuations in the price of one currency concerning another that Forex traders make their money from because these fluctuations happen daily. That's why banks would never allow you to learn Forex. They prefer you come to their banks and fix the money for very tiny interest rates. Also, note that investment banks contribute more than 70% of the total liquidity in Forex. They use your money to trade, and afterward, drive big cars and live in big houses with profit and give you peanuts as interest or meager amounts as salary. I had to come up with this analogy in the lowest terms that everyone can understand. With time, it would get clearer. But I hope by now, you all have an idea of how we make money in Forex trading. So why did you buy USD GHS in the above scenario? You bought USD GHS because you knew beforehand that the value would rise. Take note of would. In summary, we have seen that we buy when we know a currency pair will rise, and we sell when we know a currency pair will fall. The next big question is, how do we know when it would rise and when it would fall? That's where the technical and fundamental analysis we discussed in our previous lesson comes into play. Thank you for watching. Make sure you hit that subscribe button and like this video for more. See you in the next episode. Bye.